Most devastating financial collapses rarely start with a string of bad luck. They almost always begin right after an investor's very first major profitable trade. To understand why, look at how a stock is priced. There is a company's underlying fair market value, a relatively stable metric based on real assets and earnings. But the actual stock price flashing on the exchange is a completely different line. It swings wildly above and below that fair value, driven entirely by collective human emotion rather than reality. During massive momentum runs, like the dot-com boom of the late 90s, novice traders ride these waves of irrational sentiment. They buy in, guess correctly on the upward trajectory, and suddenly find themselves sitting on a fortune. But they eventually give it all back, plus their initial capital. They relied entirely on gut intuition to enter the market, which means they have no objective mathematical strategy telling them when it's time to sell. You can actually spot when this happens physically. If you find yourself sweating while watching daily price swings, your logic is gone. Your ego has hijacked the trade, and you are holding a position that is simply too large for your account. The same human intuition, engineered over millennia to keep us safe in the physical world, actively destroys our ability to survive in the financial markets. Without data, traders treat the market like a casino floor. Instead of calculating risk, they rely on hoping and praying. Psychologically, we are wired to seek immediate gratification. At the very first sign of a green tick, our instinct is to lock in that joy, causing us to prematurely cash out tiny incremental profits. Our brains also naturally recoil from pain. When a trade turns negative, we refuse to accept the loss, holding on to failing positions with the desperate belief that they will eventually bounce back. The result is a ledger filled with dozens of small victories, entirely wiped out by a single catastrophic plunge. This is the just a little bit longer fallacy. Assuming a failing position simply needs more time to recover is a mathematical certainty for destroying a trading account over the long term. By relying on hope, an investor perfectly reverses the golden rule of trading. Instead of cutting losses and letting profits run, they have built a system that guarantees small profits and invites unlimited losses. The psychological breakdown accelerates when profits evaporate. Imagine holding a position that is up 100%, only to watch it bleed all the way back down to your original break-even entry price. On paper, you haven't lost any of your initial investment, but the human brain processes that decline as stolen money. That perceived theft triggers highly irrational, aggressive behavior. The ego refuses to accept defeat. Rather than walking away flat, the trader enters the ultimate emotional trap, doubling down. They misuse the concept of dollar-cost averaging, buying more leverage on a rapidly sinking asset. The flawed logic is that by lowering the average cost of their shares, they can artificially force a mathematical recovery with just a slight upward tick. The statistical reality is unforgiving. Adding leverage to losing positions is the primary underlying cause of the most massive trading company bankruptcies across the globe. An unchecked ego and the stubborn refusal to admit a mistake will take a routine, entirely manageable market loss and mutate it into a total financial wipeout. Surviving the market requires completely abandoning your gut feeling. The alternative is systematic investing. Systematic investing means establishing rigid, mathematically tested parameters long before you expose yourself to the chaos of the market. You make the decisions before your emotions have a chance to react. On this chart, brackets explicitly label the stop-loss risk, a predefined exit calculated to autonomously cut a loss. Alongside it, points EL and ES define the counterpart rule. A strict profit target must be locked in immediately, preventing greed from keeping the trade open. A true system removes the human element so thoroughly that, ideally, a computer algorithm should be generating the exact buy and sell signals. The ultimate test of a trader's discipline is not how much they can make on a winning streak. It is the ability to manually execute a system's trading signal to close a position at a loss, without a second of hesitation. A systematic trader must execute these losing trades comfortably, even when overall market sentiment, financial newsletters, and their own gut vehemently disagree with the math.
Consistent, long-term wealth is never generated by outsmarting the market. It is generated by engineering a rigid plan that successfully outsmarts your own human nature.